Thanks for listening to the Adulting is Easy podcast, where we make adulting easier by making money easier. This is your host, Lauren. I'm joined today by Fred Moskowitz, an expert in alternative investing with a focus on mortgage notes. His book, The Little Green Book of Note Investing, highlights his commitment to educating others on its unique strategy. Fred is passionate about financial literacy and helping individuals take control of their financial futures. Thanks for joining me, Fred.
Thank you, Lauren. It's great to be here.
So, our goal for today is to make adulting easier for listeners by discussing a personal finance topic, since managing money is a big part of adulting. Today, Fred, we're going to talk about investment mistakes to avoid.
Mm,
But before we get into that, can you just go a little bit deeper about when you were starting out and how you became passionate about investing?
yeah, absolutely. I'll share a little bit about myself. I started out in life on a very long and successful career working as a computer engineer. And I spent a lot of time working at technology and startup companies. And what happened was it was a really exciting time because it was during the dot-com boom.
Wow.
And it was a wild roller coaster ride. But I watched my entire industry get turned upside down because we had the dot-com boom years and then we had the bursting of the dot-com bubble. And right around that same time, the September 11th terrorist attacks. So all this turmoil in the world. And through all of that, I realized that I was way too dependent on the income from my job, and I was taking this huge risk because I loved the work I was doing. However, my job was full of all these circumstances completely out of my control. And what I learned was that no matter how talented of an engineer I was or how valuable of an employee I was, that if things were not going well financially at the company or in the industry as a whole, I could quickly lose my job through no fault of my own. And so relying on my paycheck as a single source of income, it was a huge risk. And so through all that, I decided to take action, and I said, I want to build other sources of income for myself. Diversification, right? That's what we all learn about in investing is diversification. But what about the idea of diversification of your income stream? And so that's what led me in down this path of investing and buying and building assets. That's what alternative investments is all about. It's buying and building assets that you own and you control. And if you manage them well, they will grow and appreciate in value. But the best part is all along the way, you get paid all along the way. And that cash flow is what creates that financial resiliency that can really give so much stability in your life.
So, I think growing up, we are taught what society thinks is normal, which of course is go to college, get a job, work at that job for 40 years, maybe put a little away, retire with what you have and Social Security.
Yeah.
And so there are these very small light bulb moments that I particularly had, and I know my listeners have had over the years. And one of them is what you just said, that okay, having one income is actually pretty risky. Even though, and you're like, duh, why didn't I think of that sooner? Why did it take this bubble bursting to make me have that aha moment? But I just think that just shows you how entrenched society's ideas for us really are.
Yeah, it is. And having a good job, a good career, that's great. But my message is simply don't let that be the only thing you're doing for income. Put some focus, put some attention and intention on growing that. Find investments that you can get involved in that will help and that will round it out. And whether you need the money or not, it's nice to know it's there and you have it. And it's a great way to build wealth and build financial stability because life is full of surprises, unexpected events and detours. And so when that happens, it's nice to have uh, other income to help you smooth through that, through those rough edges.
So one mistake young people might be making is not diversifying their income. What are some other ones that you've seen?
Well, this is one I see often with investing. Uh, and during the dot com era, the dot com boom, I saw this and experienced this. You might do some stock, try your hand at some stock investing, and whatever it is. Maybe today that could be crypto. You invest in that, and you do well. You do some kind of a transaction, or you buy and hold a stock of a company you like, and you hold it for a while and you make a nice profit. So, okay, so you sell that. What happens now? The stark realization is that for most people in the common tax brackets, you're going to pay about 50% tax on whatever you earned, the profit that you got from that stock investment, whatever it is. It can be, depending on where you live, it could be 40, 50%. And so you say, oh, I made all this money and I had to give half of it back away to the government. And so a common mistake is, hey, it doesn't have to be that way. In other words, have you put any focus on doing tax planning around your investing and having a plan to minimize taxes? And I'm not talking about doing anything unethical or illegal. It's all legal. Legal means to minimize your taxes through the way that you structure your affairs, right? And so, how do you do that? Well, you have good advisors. You work with a good CPA, good accountant that's going to give you advice and guidance on how to structure things for you and your personal situation to minimize those taxes. Because if you were to extrapolate investment rate of return over the long term, and it when it keeps getting eroded by taxes, it's dramatically less than if it was tax free. What if instead you did your stock investing or whatever you did in your Roth IRA, where all the growth is tax free, right? There's all these different strategies you can do. They're available to everyone. And so the common mistake is not learning how to structure yourself to minimize taxes. And that's something you don't learn in school, you don't learn in college. You have to self educate to do that, or hire the right advisors and learn from them, or get around people that are smarter and more successful than you in investing and learn from them. There's all these different methods. Do a little of each, I say.
Yeah.
But that's one of the biggest ones I see is not not learning, and then you learn you otherwise you learn hard lesson where you get hit with a massive tax bill, and by then it's too late. You can't do anything about it.
Right. I mean, half the time you've already spent the money.
Yeah.
Right. So,
Yeah.
yeah, that's a good example. And a lot of people think that trading stocks is the only way to invest in stocks. I've come across this in my personal life. People are like, so what stocks do you buy and when do you sell and this and that? I'm like, I really don't. We buy and we're long-term investors. We buy index funds and we hold them for a long time. And that's a very tax efficient way of investing, especially when you think about it, like you said, in retirement accounts. But I think there is a time and place for that. But I think it's probably with a small portion of your overall portfolio in case another dot com crash happens, I guess,
Yeah.
right? I mean, I
Yeah.
mean, it could. What was that like at the time? Like, I think a lot of people are always trying to predict bubbles. They're trying to say, okay, we're in a bubble right now. I hear this a lot in real estate where it's '08 again. We're gonna crash 50% or blah blah blah. But like, what was it like actually working in tech at the time? Like, did people know it was a bubble? Was it surprise? Like, what was that like?
Yeah, it was. Yeah, we knew it was a bubble. I remember going to industry trade shows and just seeing extravagant spending by companies, fancy booth at the show, throwing these lavish VIP parties in the evenings. You would just see this extravagance, and it was definitely interesting. And if you were to go and look under the hood at the companies and their financial information, you would see like their revenue, um, profit margins not good, right? You would see, um, if you were working in the company, you would see decline in new business, in new customers. Um, so yeah, it's obvious, and when you're working in the company, you feel the vibe of what's going on as well. And so there's no way you cannot be aware of what's happening. And so that's what it was like. But in the world at large, you would hear like every week it would be on the news, such and such company went bankrupt or went under, they laid off, the company closed and laid off hundreds or thousands of people at once. So that was nonstop during those times.
Do you think we're in a real estate bubble now?
Well, I'll tell you, I've been a real estate investor for more than 20 years, right? Been through all phases of the cycles. And whether there's a bubble or not, um, it matters if you're selling right now. But if you have own properties that are producing cash flow, they're positive, and they're stable, you've done a good job of owning, managing them, then you're well equipped to, and you're using leverage appropriately, like not over leveraged, then you're going to be okay. Properties are going to continue to cash flow. And it only matters if you were selling right at the worst moment. But if you don't have to sell, then you hold the property and keep collecting rent. Rent continues to get paid. I own a lot of mortgages, so mortgage payments continue to get paid through a downturn. And so this is the beauty of owning those assets. Now you have to manage risk along the way. That's important as well. But if you have everything set up with good fundamentals, you're going to do okay.
So we talked about young people not diversifying their income. We talked about them not doing proper tax planning. Are there any mistakes that you see young people making when it comes to real estate investing?
Yeah, I do. When it comes to real estate investing, and you're buying properties, make sure that it's going to be cash flow positive. Don't get into a deal just to do a deal. Make sure the numbers work. And it's very possible that in your local market, the numbers aren't going to work depending on where you live. And so you may have to go outside of that, which has its own complications. Um, but that's the most important thing. If you have a property that's cash flow positive, then you're going to be able to weather any difficulties. But if you own rental real estate and it's negative cash flow, now you're feeding that. And that means you're paying it out of the proceeds from some other part of your life. And that may or may not be sustainable for the long term. And so that's very important, fundamental to look at.
You mentioned managing risk. What does that
Mhm.
mean?
Well, it depends on the asset class you're in, but managing risk means you're protecting yourself against problems, against financial threats of any kind, whether it's real estate, mortgage notes, if you're investing in a company and stock, you have the risk that the company could go under and or declare bankruptcy, and then any stockholders get wiped out in that case. Um, it really varies with asset class. In the world of mortgage notes, right? If you are a secured lien holder on title of a property, there are definitely risks that come up. But always remember that no matter what happens, the lender is secured on title on that property. And so if you're not getting paid for any reason, you're still on title, you're still in a secured position. And whenever that property gets sold or refinanced, they're going to have to address that lien and you'll get paid off. It may not be right now, maybe in the future, but that's how it is. And so this is why lenders structure loans and mortgages the way they do. It's because it's all geared around managing risk.
So let's talk a little bit about investing in
Mhm.
mortgage notes. Are you're not just like seller financing these properties, right? Like what does it mean to be investing in mortgage notes?
Yeah, that so seller financing is one way, certainly. And I know a lot of investors that do that. That's their specialty. I focus on buying loans that already were originated, usually by banks and financial institutions, but they get sold on the secondary market. And so we go in and invest in the paper. We're buying those notes and mortgages and holding them, and you get to step into the shoes of the bank when you do that. And the way I always like to talk about it is that as an investor you transition from being the one making the monthly payments to being the one receiving the monthly payments. Most investors, when they think about a note and a mortgage in the context of real estate, they think about being the borrower. But what about being the lender? And so that's what it is. And so when you buy a note, you become the secured lender on title, and now you receive those monthly payments every month. That's how you earn a rate of return for your cash outlay when you bought the loan.
So I would love to seller finance something in my
Hmm.
future. I think it's a good way to honestly diversify. And
And
then
there's
if
tax
somebody,
strategy with it too.
yes, you get to, you instead of taking, your gains all at once, you get it over time.
Yeah,
It's a big deal. Also, if the person doesn't pay, you get the property back. So as long as they have a good enough
yeah.
down payment and they don't destroy the property, right? But this idea of actually investing in the mortgage notes themselves, I probably admittedly haven't given enough thought to. But when you're doing that, are you investing in a single note or is it a bucket of notes in case somebody stops
Yeah, that
paying?
that's a great question. Um, you can do both. So whenever an investor comes to me interested in doing mortgage note investing, there's two ways to do it. If you want to be an active investor, then that's the first example you said, where you go out, you buy one note or a group of notes and build a portfolio and manage and maintain that. That's active investing. And also you can be a passive investor where you invest in a note fund. And in a note fund, the fund managers, they go out, they raise capital from investors, pool it together in the fund, and then they go out to the secondary market and buy notes in bulk quantity. And so for the investors, they're not investing in one specific note. Their investment is spread out over hundreds or thousands of notes. And so if there's one that stops paying, then all the other notes carry the load. as well. And so that's a great way to manage risk. And so investing in a note fund is wonderful for someone that maybe doesn't have time. Maybe it's someone that is busy, focused on their career, or you're a business owner and you're focused on that. And you say, hey, I love the idea of investing in mortgage notes, but I don't have time to get involved in the intricate details. And so a note fund is a way to be a passive investor where it's fully hands off and managed for you. And there's no right or wrong answer with being active or passive. It just depends on your own individual situation and your goals. And in addition to that, I've seen so much investors transition from active to passive or passive to active because their stage of life changes. That's normal.
Yeah, that makes sense. So just this is maybe too much in the weeds, but I'm curious. So the note funds, when
Mhm.
somebody refinances or sells their house or pays off their house, what happens?
Then that the proceeds of that payoff goes back to the lender. And now for the fund manager, they receive that capital back. Now their job is to go out and redeploy that into new notes. And
Okay.
so that's for us as note investors, this happens on an ongoing basis. We just had one yesterday, received a payoff from a loan. And so that's an infusion of capital. So now what's our job as investors? To turn around and reinvest that as quickly as possible. Because when you have cash sitting idle in your account, the yield on that is zero. And you want to minimize that as best as you can.
So when you're investing in these funds,
Hmm.
like right now, the interest rates that people are paying for mortgages are relatively high. But if rates drop,
Yeah.
then like I guess my question is like you can sort of assume you're gonna make whatever X amount of dollars from these note investments, but if rates drop, does that like torpedo your whole plan? Because now everybody's refinancing and
It has an impact in multiple ways. So the dynamics of refinancing and payoffs that happens quite slowly. Um, and the other thing is that a lot of the loans we buy, they've been originated in the past, could be 1 year ago or 5 years ago, and so the interest rates of right now, yes, there's an impact, but it's not as much as you would think. And a big part of that impact is in the pricing of loans on the secondary market. That's where we see the change. But a loan that was originated 5 years ago at a specific interest rate, that's a contractual obligation, and that won't change until the loan gets paid off,
Mhm. Okay.
unless it was an adjustable rate mortgage or something like that, obviously. But most loans are fixed rate.
So with so talking about interest rates generally
Mhm.
in real estate, just real estate investing wise, is now a good time or a bad time to invest in real estate?
If you can find a property in a good area that's positive cash flow and it's in a neighborhood where people want to live and will attract good tenants and the numbers work, then that's great. That's it.
Some
It
people think it
doesn't
doesn't exist.
it
Some
doesn't
people think
matter.
it those are gone, never to be
No,
seen again.
I've been through this before. Yeah. Um, it's changing every day. The markets are changing, and as an investor, you need to look and get comfortable with the markets and watch the average days on market for properties, which in many locations that's increasing now.
Hmm.
Properties are sitting longer. Um, so there's definitely opportunity out there. It's not easy. You might look at 100 properties and then make an offer on one, and that's okay. You don't want to be in a hurry or in a rush and say, "Oh, I have to buy a property by such and such date." No, you keep looking and be patient and stick to your fundamentals. right? The fundamentals are cash flow. Will the property support itself with a little bit of margin to cover the unexpected detours of life?
Mhm.
That's it. If you can do that, then great. If you have to put a little bit more money down to take on less leverage and be in a better position, that's less risk. That's fine. Do that. So get started. And if right now is not the time to buy in your market, focus on your education, learn, join a real estate investment group, go to the meetings, take advantage of the education they offer. Um, those are the things that you can do while you're learning about the market, while you're looking for a deal to buy.
There's somebody out there who's listening and heard you say that you were working in tech at the turn of the millennium and for 9/11, and they're in their 20s and they were not born then. What would you say to them about, like, if they should have a positive outlook on their financial future or a negative outlook on their financial future?
I would say, what kind of an outlook do you want? And remember the words of Henry Ford. If you think you can, or if you think you can't, you're absolutely right.
Yeah.
That's it. And so part of this is around your mindset. What are you focusing on? And whatever you focus on, your effort, your energy, your intention, that's what's going to grow and expand.
Yeah. This is something that a lot of people have been asking lately with Charlie Munger has passed away, Warren Buffett is retiring, and something that those guys would have given all their money for was to be in their 20s right now, right?
Yeah.
I mean, and that, I think that says a lot. There's opportunity out there, and time is on the side of young people, people in their 20s, 30s, 40s. I mean, you have so much time still, and people that are older than you, even if they're wealthier than you, they would take that time because that's really all
Yeah.
that we have.
That's right. That's exactly right.
So, Fred, is there anything else you want to add before we wrap up?
Well, I will say that in closing, one of the most important things that we can do as investors is focus on education, learning, and growth. Um, whether that's traditional education, attending classes and workshops, or doing things online, reading books. If you're interested in learning about mortgage note investing, you could read my book. It's available on Amazon. But focus on learning no matter what area you're interested in, and that's an investment that you're making in yourself, and nothing will pay higher rate of return than the return on that energy.
Why don't you let people know where they can find you on the interwebs?
Yeah, absolutely. Uh, Best way to connect with me is to visit my website, which is fredmoskowitz.com. However, if you prefer a little bit of an easier spelling, you can go to giftfromfred.com. It'll take you right to my website. I have a special report on note investing that I'd be happy to send out to you. And always love hearing from investors. So reach out and connect with me. And it's all about building relationships. One of the most important things we do. And you can find my book. It's available on Amazon, The Little Green Book of Note Investing. And reach out if you'd like to continue the conversation. Reach out, connect with me on my website. And Lauren, thank you so much for having me on today.
You're welcome, Fred. Thank you for being here. And everybody, you can follow me on Twitter X at Adulting is Easy, Instagram Adulting is Easy Real, YouTube at Adulting is Easy. If you like this episode, you'll also like episode 204, Definition of Courage, Act in Spite of Fear. Thanks
Mm.
again for listening, everybody. Hopefully, Fred and I have made adulting a little easier for you.